Heading into 2022, we still like Chevron, still on the list. We still like Verizon, still on the list. And we're also picking Dow Chemical, which is the #1 name on the list. And you certainly don't want to be #1 on this list for too long. All three of these names are really well valued, plus 4.5% dividend across the board. And good things tend to happen to cheap stocks. Don't believe in the strategy, Joe, but you can look for these names for opportunities.
Eugene, the first week of January can be important, and you expect the rest of the year, maybe you think that the tax loss harvesting is, maybe people are winding that down. So maybe we get this Santa Claus rally this week, and then the first week of January could be solid. That would portend good things for next year. You like the markets here?
I do, at least for the start of next year. I think that you've already had enough of a Santa Claus rally to be above the average, because I think you're up 1.5%, 5% last week. And so even though we're flat this week, we still had a successful Santa Claus rally, okay? I think that the reason January will be a little bit higher is that during November, December, you had investors selling off riskier assets, riskier names. I think they're going to go back into those names in January. So you're going to get a little bit of demand for the stocks that were high flyers for most of last year. Going back to what you were talking about with dogs and dollar strategy, I actually think that that's going to be a good strategy the second part of next year, because I think value is going to take over. As Kevin said, the strategy's underperformed for the last 4 years. But unfortunately, corrections are an inevitable part of market cycles. And eventually, we're going to have a downturn in this market. We're going to have higher interest rates. We have very high PEs. And certainly, due to FOMO, investors are continually rotating around into successful names. Momentum investing has been winning out. But I think 2022, the second half of the year, we're going to see a little bit of correction here. I'm kind of in the camp that we might be positive next year, but I think it'll be a single-digit return.
Like when we put the pandemic to rest, which hopefully, I'm hoping second half, that would make sense. When we put it to rest, then the market takes a breather. The way things work, right? Buy on the rumor, sell on the news finally happens, and then maybe you've already had a lot of the relief rally from it.
I think that's correct, Joe. And if you look at what we're doing with Omicron, right, and certainly milder symptoms is a great thing, right? And investors have focused on that, and so we haven't had sell-off in the market as a result. But if you look at mobility this weekend, no one expected all these flight cancellations, and the flight cancellations are occurring because of labor shortages. That's happening across the board. Rather than real estate, anywhere, employees are out, and so even though we're not shutting down, you're going to get a slowdown in productivity, and there's going to be a reduction in some of the sales. So I think that net, we've been a great market for a very long time, but we certainly are overdue for bringing the valuations from double the standard historical PE.
Well, it's tough, Gene. We're trying to figure out whether our response as a society should be commensurate with what we did with Delta and with the other COVID. And if it is, I mean, you mentioned maybe the symptoms are less, but if we have the same lockdown sort of mentality or supply chains around the world could be affected the same as before, even though the symptoms aren't as bad. But it's going to be hard to make that transition where, you let people go back after 5 days instead of 10 days. The supply chain issues could be just as bad as the original wave, even though the virus itself is not as bad. I don't know if we've considered that, and we saw it over the weekend.
Well, let me give you one quick example. I took a trip over the holidays, and because I was not going to get on a plane, I drove 9 hours, right? So just me personally, instead of paying for a plane ticket, I paid probably 70% less by driving. A lot more effort. I felt a lot safer. And I think that that's happening in a lot of cases. People make individual decisions that are going to infect revenue overall through companies. So even though we're not locking down, I do think that we're going to have a slowdown impact from this variant.
First half hour is pretty good, Gene. I've found it's like, this is okay. This is not bad. Then you got that 8.5 ahead of you. That's the only problem. All right, Kevin, besides, it was good. I like lists too, but other than Dow, dogs, and et cetera, you like active management. What else you like? What else should you be loading up on, if anything?
Well, I think that Gene was right that we're probably not going to see trees grow to the sky, meteoric double-digit returns, 20+% numbers next year. So I think it's having a little bit of caution heading into 2021 isn't a bad idea. Tempering your expectations, but looking at quality, looking at profitability. You know, we mentioned dividends as a huge part of it. It doesn't mean you need to abandon growth. I mean, you know, we own Microsoft, Apple, and Cisco within the technology space. Maybe not huge dividends on the first two, but nice solid dividend growth. The other thing we're absolutely going to be taking advantage of in a heightened volatility environment, which we're expecting, we're going to be writing a lot of covered calls. We're going to keep a little bit of dry powder. And active management's important because we talked about 3 stocks that we own in this list for 2022. By no means does it mean that those are going to be names that we'll own at the end of 2022. Yep.